Back on Morning Mover, shares of HIMS and HERS are not recovering to begin the week after the stock fell some 26% on Friday after the FDA announced there was no longer a shortage of Ozempic and Wegovy. Due to the shortage, keep in mind HIMS and HERS was allowed to sell alternative versions of the weight loss drugs, compounded versions. The company will have to halt production of its alternatives by April 22nd. Now, the stock remains up more than 400% in the last year, and it hit an all-time high of $73 last week before this sell-off. With that, time now for Options Corner. Joining us now to take a deeper look at HIMS and HERS, we've got Rick Ducat, Duke of Data, lead market technician. All right, Rick, when you look at the chart for HIMS and HERS, what are you seeing in terms of trends?
The big rally came mostly during this year. Year to date, we're still up 103%. So even with that rather severe decline we saw on Friday, still quite up notably on the year, and also still hanging on to this trend line, our white dashed line here going across this series of lows. That's about where price closed. So an interesting development. We're kind of on a potential tipping point here by that measure. Notice as well, very heavy volume recently, both during the rise as well as on the fall. The heaviest volume was during Friday's difficult situation there. Notice as well, RSI not only out of the overbought area, but approaching that 50 midline now, and our trend line has been invalidated here. So a couple points to watch as we look a little closer at the chart here. We can see that we're between our +2 and +1 standard deviation channels. Those give us some kind of natural boundaries to keep an eye on at about 52 for the +2 channel and about 43 or so for the +1 channel. So a couple areas to consider, Diane.
And then I'm curious to know, Rick, what the options activity looked like on a Friday, especially if there was any bullish activity in the context of, this was clearly seen as a negative in terms of the stock reaction. But what did the options activity look like?
So there were some interesting trades here. In terms of the open interest, though, this Friday's expiration is the highest open interest. It was a little unusual, too, because it's much heavier on the put side. The put-call ratio is about 1.78. So, almost, not quite, but almost twice as many puts as calls in terms of open interest. 45 to 75 is the range for the calls, the most important area. The top puts are listed here, but there's other pockets spread down as far as 25 all the way up to 65. The biggest trades that I saw, they looked like they were done at the same time. One was the April 17th 60 puts, the other was the April 17th 50 puts, closing the 60 puts with selling, opening the 50 puts with buying. 7.2 million debit for the opening, bearish large trade there, and it looks like the other one paid off to the tune of about $2 billion based on the previous trading activity on February 14th.
Well, that's a nice payoff. All right, Rick Ducat, thanks a ton for that options activity there and the chart. All right, time to take us through an example trade. We've got Tom White, senior options contributor and co-host of Fast Market. Tom, how would you structure an example trade in the context of this news that we got about Wegovy and Ozempic and how that relates to HIMS and HERS?
Well, I think you better expect some volatility on this one due to the fact that the option market's priced in about a plus or minus $11 move in the shares post earnings. That's about 22% if the stock's trading right around that 49 level. So keep that in mind, because IV percentile rank is at the 99 percentile, which means it's at the high over the last 52 weeks as far as implied volatility levels go. This is going to be a key report, I think, after the close tonight. So keep that in mind. So I looked at a strategy that takes advantage of me profiting in 3 out of 4 scenarios on this one and taking advantage of that high implied volatility levels. So I looked at a broken wing butterfly, but it's on the call side. I'm buying it, but I'm actually collecting a credit on it because we made it a broken wing or unbalanced call butterfly. So out in that February 28th weekly cycle, you're going to capture tonight's earnings, expires in 4 days. We're going to buy 1 of the 55 strike calls, sell 2 of the 57 strike calls, and then wrap it up by buying 1 of the 64 strike calls. So an unbalanced one there. You're going to collect roughly about $1.75 credit with the stock trading around 49 bucks. So what does that mean? Well, you can see here from the risk profile, it takes my break even on this one where I start to lose money above $60.75 because I collected that credit. Now, if the stock falls, I just get to keep that credit that I collected anything below that 55 level, I just get to keep the credit collected. Now, I got that little kicker right around the short 55 strike where I sold 2 options on it. You're risking about 375 to make about 325 at the apex of profitability, but 3 out of 4 scenarios, you profit, right? Stock goes lower, stock stays where it is, or stock goes higher, but stays within that 1 standard deviation $11 move that the option market's pricing in, and you can be profitable on this, even if the stock does move higher, just taking advantage of some of those higher implied volatility levels. You just don't want this stock to spike back to those all-time highs that we saw last week.
That's the one scenario you don't want. All right, so this works in 3 out of 4 scenarios. That's good odds.
Yeah.
All right, that's a call butterfly example trade on HIMS and HERS. We've got earnings coming up for that company. Thanks a ton, Tom.